PPOs can be organized by employees or by health care providers themselves. The contract between the employer and the health insurance provider, whether physical or hospital, spells out the kind of service to be provided. Insurance companies can also contact the PPO to offer services to insurers. Government as insurer. As noted at the beginning of this unit, federal and state are also insurers, provided what are commonly called the social insurance programs, ranging from crop insurance to bank savings and loans deposit. These programs have far-reaching effects. Millions of people rely on these plans. Social insurance programs include the following: old age, survive, and disability insurance. Acronyms are OASDI, commonly known as Social Security. Social Security Hospital Insurance, HI, and Supplement Medical Insurance, SMI, commonly known as Medicare, Medicare. Medicare, the government plan, plays a vital role in providing social insurance programs. These programs pay billions of dollars in benefits every year and affect millions of people. Self-insurers. Though self-insurer is not a mention of transferring risk, it is an important concept to understand rather than transferring risk to an insurance company. The self-insurer establishes its own self-funded plan to cover potential loss. Self-insured is often used by a large company for funding pension plans and some health insurance plans. Many times a self-insurer will look at an insurance company to provide insurance above a certain maximum level of loss. The self-insurer will bear the amount of loss below the maximum amount. How insurance is sold. Insurance is sold by a variety of companies and methods. Most common purchase insurance through licensed producers who present insurance products and services to the public via active sales and marketing methods. Insurance producers may be agents who represent as a particular company or broker who are not tied to any particular company and can be represented in many insurance products. The sales transaction agents represent the insurance brokers represent the buyer. An agent has an agent's contract as a broker's contract. Agents are also classified as captive or career agents and independent agents. A captive or career agent works for one insurance company and sells only that company's insurance policy. The independent agent works for himself and sells insurance products as products of many companies. The agent contract and appointments are with the insurance grant the authority to bind an insurer to an insurance contract. In any dispute between the insurance or the beneficiary and the insurer, the agent who solicits the insurance application represents the insurer and not the insured or beneficiary. In most states, however, the agent may represent as many insurers as will appoint him. There are 3 systems that support sales of insurance through agents and brokers. These are career agency systems, personnel producing general agency systems, and independent agency systems. Career agent systems. Career agents are branches of major stock and mutual insurance companies that contracted to represent and insure in a specific area. In career agencies, insurance agents are recruited, trained, and supervised by either a manager, employee of the company, or a general agent, GA, who has vested right in any business written by the GA's agent. GAs may operate strictly as managers, or they may be devoted as at a portion of their time to sales. The career agency system focus on building sales staff. Personal producing general agent system. The personal producing general agents PPGA system is similar to the career agency system. However, the PPGA do not recruit, train, or supervise career agents. They preliminarily sell insurance, although they may build a small sales force to assist them. PPGAs are generally responsible for maintaining their own office and administrative staff. Agents hired by PPGAs are considered employees of the PPGAs, not the insurance companies, and are supervised by regional directors. Independent agent systems. Independent agent systems is created a property and casualty industrial and do not tie a sales staff or agency to any one particular insurance company. Insurance independent agents represent any number of insurance companies through contracted agreements. They are compensated on commission or free basis for the business they produce. This system is also known as American Agency System. Other methods of selling insurance. While most insurance is sold through agencies or brokers under the system previously described, a large volume is also marketed through direct selling and mass marketing methods. With direct selling methods, the insurer deals directly with the consumer by selling its policy through vending machines, advertisements, or sales or salary sales. Representatives, no agent or broker is involved. A large volume of insurance is also sold through a mass market of technique such as over the internet, newspaper, magazine, radio, and television ads. Mass market methods provide exposures to large groups of consumers, often using direct selling methods with occasional follow-ups by agents. Evaluation of industrial oversight. The insurance industrial is regulated by a number of authorities, including some industries itself. The primary purpose of this regulation is to promote public welfare by maintaining the solvency of insurance companies. Other purposes are to provide consumer protection and ensure fair trade practices, as well as a fair contract at fair price. It is very important insurance agents understand and obey insurance laws and regulations. A brief overview of the history of insurance regulations will show a seesaw between the authority and states and the federal government. Through a balance between the two bodies have reached and maintained for many years. Arguments favoring controlling by one government authority over another is still being waged. (1868) Paul v. Virginia. This case was described by the United States Supreme Court involving one state attempt to regulate an insurance company domiciled in another state. The Supreme Court sided against the insurance company, ruling the sale and issuance of insurance is not interstate commerce, thus upholding the right of sales to regulate insurance. 1944 United States versus Southeastern Underwriters Association, SEUA. The decision of Paul v. Virginia held for 75 years before the Supreme Court addressed the issue of the state versus federal regulation of the insurance industry in the SEUA case. The Supreme Court ruled that the business of insurance subject to a series of federal laws may of which were conflicted with existing state laws, and that insurance is formed of interstate commerce to be regulated by the federal government. This decision did not affect the power of state regulate insurance, but did nullify state law that were in conflict with federal legislation. The results of the SEUA was to shift the balance of regulatory control to federal government. The 1945 the McCarran-Ferguson Act. The turmoil created by the SEUA case prompted the Congress to enact public laws 15. The McCarran-Ferguson Act. This law made it clear that continued regulation of insurance by state was the public's best interest. However, it also made it possible that the application of the federal antitrust law to the extent that the insurance business is not regulated by the state. This act led each state to revise its insurance law to conform to the federal law today. The insurance industry is considered to be state regulated. A fine of $10,000 or up to 1 year in jail is the penalty for any person who violates the McCarran-Ferguson Act. In 1958, intervention by the FTC. In the mid-1950s, the Federal Trade Commission, FTC, sought to control the advertising and sales literature used by the health and insurance industry. In 1958, the Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC. A federal agent additionally attempted to have made by the FTC to force future federal control, but none has been successful. 1959 intervention by SEC. In this instance, the issue was variable annuities. Are insurance products to be regulated by the state or securities to be regulated federally by the Securities and Exchange Commission, SEC? Question mark. The Supreme Court ruled that federal security laws apply to insurers that issue variable annuities and thus require these insurers to confirm both SEC and state regulation. The SEC also regulates variable life insurance. 1970 Fair Credit Report Act is an attempt to protect individuals' rights to privacy. The federal government passed Fair Credit Report, which is the authority. They require fair, accurate reporting of information about consumers, including applications for insurance. Insurers must inform applicants about investigations that are being made. If any consumer's report is used to deny coverage or charge higher rates, the insurer must furnish to the applicant the name, reported agency conducting the investigation. Any insurance company that fails to comply with this act is liable to the consumer for actual and punitive damages.